get started with today's webinar topic. It's all about selecting the right debt for your multifamily acquisition. These webinars that we do every Tuesday, they are designed for all of you out there. So again, if you have questions, use the chat box, stop me as I'm going. We want to make sure that you're getting the most value from these webinars to help really grow your business and help you all make better decisions for growing your portfolio and your investment. And with that being said, selecting the right debt, very complicated options that are out there given today's economics and where the US Treasury rates are going, what the Federal Reserve is doing, what the Fed funds rate is doing, what different lenders are doing. And so, selecting the right debt is a huge decision when you're evaluating your investments. And you want to make sure that, whatever debt you select works with your underwriting and gives you a nice conservative business plan and approach. And so we can really break this down. I don't want people to think, to be overwhelmed by the debt, because there are a lot of options out there and a lot of challenges that are coming up today. So let's kind of break these things down. The first one is, should you use a debt broker or not use a debt broker? I personally find very good value in working with a high quality debt broker, given today's market complexities. Even before the complexities, the value in using a broker is that they will go out to probably 100 or so different lenders that are in their distribution list or contacts and get bids and feedback from all of these various sources to make sure that they can size up and get the best quotes for your deal. A good broker will size up a deal for a loan through multiple channels. So the multiple channels are agency loans, so Freddie Mac or Fannie Mae. It could also be a small balance loan if it's a smaller value amount, but Freddie and Fannie both do small balance. So agency is one route. Life companies are another route, like an insurance life company. You also have private banks, and you have your private kind of portfolio bridge type lenders that are out there. And so it's important to get out in front of all of those various lender options to get feedback and sizing, to make sure that the option you select is the best for your deal. And a good broker will go to all those channels. They'll get you fixed rate options to look at. They'll get you floating rate options to look at. And it's going to let you really get a wide variety of options, so you can plug each of those options into your underwriting and figure out what is the best loan for your deal. So if you're not going to work with a broker, then I think you need to take on that work to go and get feedback from those various lender channels and make sure that you're sizing the deal appropriately. Now, a rough rule of thumb when you're talking about debt, if you are buying a multifamily deal or really any investment property that is under $1 million in debt. So if you think about it, if you're buying a $2 million property and it's going to be a 50% loan to value, you are at about $1 million in debt. $1 million in debt is, again, a very rough rule of thumb, but $1 million in debt, if you are under that threshold, chances are you need to go to a local community bank or credit union in your market where the property is located to get the most advantageous terms. If that's the case, if it's under $1 million in a loan amount, then you should personally shop that deal with, 5 or 10 local credit unions or community banks and see what the best option is for your deal. Any deal $1 million and up would be a good fit to really shop it with a broker and go to those various sources, whether it's an agency, a life insurance company, a private bank, or a bridge type portfolio lender. Let me pause here and see if there were questions coming in to the chat box. There are no slides. Hannah, we had a question in here. It says the code has expired. If you could just please double check that webinar DR100 code so folks can get their discounted tickets for the MFIN conference. So Leonard in the chat box had a question on that. So if your loan is above $1 million, then definitely shopping it among those, agency, life insurance companies, private banks, private lenders, portfolio lenders. You definitely want to shop it out there and really make sure you're seeing a wide variety of quotes to make sure it fits with your specific deal. The second item, the types of debt options, right? There's a lot. There's fixed options, there's floating options. The way I think about it is the individual term. So the interest rate is one important component to it. The timeline is another important component. The amortization is another important component. And so it's important to have all of those items organized so you can really compare one quote versus another. If some of those items that I just rattled off, like interest rate, amortization, the term of the loan, if those don't resonate with you immediately and you're not quite familiar with that, then you definitely need to work with a broker in shopping your deal to make sure you're getting the best types of debt options out there, as well as learning the vocabulary that comes along with it. It'll be a very good and beneficial use of your time to work with that broker to understand how the lingo works within the debt world. It can be a little bit challenging if you are new to the space, but there's a couple of key terms that everybody kind of works with, and a good broker will set up a kind of a quote matrix, they'll call it. So it'll be like an Excel spreadsheet with a couple different lenders in columns and then the terms, and it's kind of summarized nicely so you can really pick and choose from that. So within the types of debt options, fixed versus floating is a huge thing today. So fixed rate loans are great because it locks in your interest rate for a set period of time, typically 5, 7, or 10 years. However, one of the drawbacks to that is if you originate a loan today, let's just say it's a 10-year fixed loan with one of the agencies, either Freddie or Fannie, it means you're locking in your interest rate for the next 10 years. So while it's great in this, in today's environment where interest rates are changing pretty rapidly, it might not be the best thing if rates settle out over the next 24 to 36 months and maybe tick downward. you might be in a position where you're paying a higher interest rate for 7 more years compared to what the interest rates are in the future. So what do I mean by that? Well, if you think about your home loan, right? At any point in time, you can refinance your personal home mortgage and get a better rate um, based on any point in time. However, this third bullet point here, prepayment and or yield spread maintenance, is a huge component to think about. So when I talked about that quote matrix, you'll definitely want to look at the line item for prepay, and then is it yield maintenance, is it spread maintenance, is it defeasance? So a prepayment penalty for the agency loans, it could be yield maintenance or spread maintenance. And basically what that means is if you sell your loan, if you sell your property and pay off your loan early, or if you refinance your property, you could owe the lender all of the interest for the remainder of your loan term. So let's say you originate today a 10-year fixed rate agency loan, and in 5 years you sell that property, you likely will owe the lender the remaining 5 years of interest, full interest on that loan, even though you're paying it off early. It's how the agencies are able to lock in pricing, and the agencies really kind of package up and sell off these loans to securitize them. So ultimately, someone is going to need to collect on that agreement of the interest paid for a period of time. And so it's the cost benefit analysis that you need to do. And again, like I said, if these terms are not familiar with you, it's even more important to work with a broker or someone who has a lot of experience in making these types of loan decisions, because you don't want to get trapped into a loan where you might not be able to sell that property because you still owe so much in interest or in what they call yield maintenance or spread maintenance for the remaining duration of that loan. Prepay or exit fees are something that are a little bit more straightforward. Some loans will charge a quarter of a point, maybe a half a point, maybe 1%. Some lenders may have a step down approach. So you might pay a 3-point exit fee if you sell in the first 2 years. And then in the third year, it might step down to a 2-point fee. And then in the fourth year, it might step down to a 1-point fee. And then after the 5th year, you may have no exit fee at all or prepayment penalty. So it's very important to know those different options and how things work, because some people can definitely get trapped with thinking like, okay, I want a fixed rate loan and I want the term to be as long as possible, which is great for immediately today, but it might not be the best thing for you in 3 years from today or 5 years from today. So you definitely need to think about those things and really compare the options that are available to you. Let me pause here and check the chat box for any questions. Okay, the discount code has been corrected. So thank you everyone for your patience. You can go ahead and use that code again to get your ticket for the conference, the Multifamily Investor Nation conference coming up June 12th, 13th, and 14th in Charlotte, North Carolina, 2023. All right. Teresa has a question here. Is it customary to provide our underwriting to the mortgage broker for them to ID the best financing available? Yes, it is customary to do that. A lot of lenders or brokers will ask you for your underwriting or your projected kind of 1, 3, and 5 year pro forma. So depending on how close of a relationship you have, you don't necessarily have to provide them your underwriting model. I think it's easier to just send them what you're using, but you could also maybe kind of remove some things from your underwriting if you don't want to share everything with them, or maybe just send them the pro forma of your income and expenses and net operating income for the next 1, 3, and 5 years and get them what they need. So it would just be a conversation with the lender or the broker of kind of what exactly are they looking for. Personally, when we're working with our brokers, we just send them our model and they use it and it works out very well. It's a little bit easier for us to just send them that and be done with it. Can the fee for the prepayment be transferred to the buyer? So absolutely, could the buyer pay that? But it just depends on really what the market is doing at that time. So I wouldn't necessarily say, hey, buyer, you need to pay my prepayment penalty for the loan. I would just kind of build that into the agreed upon purchase price that they're getting to. So you gotta kind of have to think about that. I don't know too many buyers that are out there who will, pay the purchase price and then tack on some sort of extra fee. It just doesn't make sense. Think about it. If you're the buyer, you're probably just going to want to pay the purchase price and that's it. So, build that into your negotiations. If you're in like a best and final round and your prepay fee is, I'm making it up, 250,000, maybe you go back for that last time and kind of say, hey, the deal is yours if you pay, 250K more. And, everybody's kind of happy at that point. I wouldn't necessarily say, hey, in addition to the purchase price, you also need to pay this. But if you can do it, great. It never hurts to ask. It just doesn't seem like a lot of buyers would be willing to do that. And I'm sure all of us as buyers wouldn't want to do that either. Anyone at this point, I'm just going to open it up for questions. There's a couple really good ones coming in here. So use the chat box if you do have questions. I'll answer as many as we can, and then we'll wrap up for the day. What terms did you get on your most recent loan? So we went out for a larger multifamily deal. We had a broker go out and kind of blanket the market. So like I said, they go out to like 100 different lenders and get quotes. So we had good quotes from the agencies, both Freddie and Fannie quoted. We were at, I'm trying to think about what the spread was. The challenge with the agencies today is that the 5-year, 7-year, and 10-year US Treasuries have been going crazy over the last 60 days or so. And if you don't know what I mean, just go into Google and type in like 10-year or 7-year US Treasury rate. And you'll see the rates have been moving by 10, 20, sometimes 30 basis points in a day. And it is um, unheard of at that movement compared to historical numbers. And so when an agency like Freddie or Fannie is going to originate a loan, they will set based on the term of the loan. So if you're going with a 5-year fixed rate term, they will peg your interest rate off of a spread plus the 5-year US Treasury index. And so if the index is at 300 basis points, and the agency is also going to charge a 300 basis point spread, you would be all in at about 6%. And so for us, the most recent terms, the interest rate was fluctuating really daily until you're able to rate lock, because the US Treasury indexes all move daily. And so that's something you have to keep in mind when you're evaluating debt options as well. The US Treasury rates will move constantly. And so for us, we had good quotes from Freddie and Fannie. Kind of the best quote was in that 7-year fixed rate option. We were able to get full term IO for 7 years. And then our interest rate was pegged off of the 7-year US Treasury index, which again was going up and down and up and down, like crazy. So that was another option we had. And the quotes were all around 55 to 60% loan to value. So very low leveraged, very conservative. All of the numbers worked well with our underwriting that we had, so it was a sound deal there. We also had some competitive life insurance quotes, all very similar terms to the agencies. And then the other important piece, the life companies tend to have lower exit fees, whether it's yield maintenance, spread maintenance, or just a fixed rate to pay, versus an agency. Again, going back to what we previously talked about, that yield maintenance or spread maintenance can be extremely costly if you're ever trying to exit an agency loan early. Therese had another question here. Do you use more than one mortgage broker per deal to source your financing options? No. So the rule of thumb is you work with one broker per deal, because that broker is going to want to go out to, like I said, 100 different lenders. And if you have two brokers working on the same deal, they chances are will go to the same lenders and try to get quotes, and it just gets really confusing. People get frustrated. Lenders won't give quotes to two different brokers. So pick one broker, work with them on the deal, and don't try to shop it with another broker, because really the broker is going to go to the same lenders in most cases. I heard that last week there was actually a drop in the SF. Marina, what do you mean by SF? I just want to make sure that we're talking about the same vocabulary. Did that happen in the multifamily world too? What has been the DSCR lately? Any increase? Most lenders are working off of a 1.25 DSCR requirement from an agency perspective. Some of the private lenders could work off of like a 1.0 at closing if you are showing a business plan that gets you up to a 125 coverage at some point in the future. If there are any more questions, please put them into the chat box. A rate drop in the single family arena versus the multifamily arena. The rates for single family and the rates for agency deals, multifamily, all kind of go off of those US Treasury indexes. So if the 30-year index dropped, that's probably where that single family pricing came down a little bit. They don't work quite hand in hand, commercial versus residential multifamily, or excuse me, residential mortgages. So I would just, check with a broker. They have a good pulse on where pricing should be at roughly if you're not following it in and out. So do that and check it out. That being said, I think we got through all of the questions. So thank you everyone for joining. Happy Thanksgiving. Check out the Multifamily Investor Nation Conference coming up June 12th, 13th, 14th, Charlotte, North Carolina. Use that code webinar DR100 to buy your discounted ticket, and have a great holiday week. Have a good weekend, and we will catch you next week for the next week's webinar. Take care.